Welcome back, everybody. Now, investors still widely expect the Fed to cut borrowing costs by a quarter percentage point next week after the latest CPI figures rose in line with expectations. Well, I couldn't be more happy to discuss all of this with Jim Bianco, president of Bianco Research. Jim, I have a million questions on crypto, on treasuries, on everything in between. But what are the charts that you're looking at to see what equities do next?
I think it's going to be pretty much inflation and interest rates. The equity market is basically benefiting from stable to low interest rates right now. If interest rates were to start up, I think that could pose a headwind for it. And for what's driving that is the inflation data. And the inflation data came out yesterday, and it wasn't bad enough to stop the Fed from cutting rates. So it looks like we're on board for a rate cut next week.
Okay, so this is one of the charts that we picked out that you sent through, and it basically shows America's stock market worth twice its GDP. I guess, is there a Trump trade? Has that already largely been done because it's underestimating inflationary pressures, or does it unlock animal spirits?
No, I think the animal spirits have been unlocked. And what the chart shows is that the U.S. stock market is richly valued, or maybe even fully valued at this point. I don't know if you want to say overvalued. And historically, valuation is an important tool, not because it's a timing tool. The market could go up a lot next year, but it tells you that over the next several years, if you're buying an overvalued market, you should expect lower returns. And a lot of the metrics that you look at when to try and measure the lower returns, you might be looking at a stock market that could be returning you 6 or 7% in the next decade or so. But people are used to 20%, and that's a problem right now.
Look at that. That's the charts. What about when you look at a lot of the onshoring that's been happening? Does that change under Donald Trump, or are we going to see more volatility?
No, I think that, as far as when Trump comes in, the concern you would have is that you're going to see stimulus. You're going to see extension of tax cuts. Yep. You're going to see deregulation. You're going to see an economy. The U.S. economy has been growing quite strongly. That's going to get extra stimulus from a Trump administration. Not to mention that you might see some form of tariffs, and we all debate on how much and where, that could be inflationary. That is going to make a very strong nominal growth economy. The concern has always been, why is the Fed cutting rates in this environment? It doesn't need it. And the concern is all they're doing is fostering a more higher expected inflation.
Yeah, so on tariffs, how and when? Look, overnight, CBS was reporting that actually Donald Trump invited Xi Jinping to his inauguration. I'm not sure quite how to take that. Is that means that, I want to negotiate, so hold on for the tariffs? Or is it just psychological kind of, wargaming?
That is the $64,000 question in the United States. What is his plan? Is it gambit? Is it that tariffs are leverage to get something else? Or does he just want tariffs? I'm in the camp that it's leverage, that he wants to threaten tariffs as a punishment for not giving him a deal on something else somewhere down the line. Ultimately, we'll get deals and we'll get less tariffs. Others make a reasonable argument that, no, we'll get less deals and more tariffs. That's going to be the big question. Inviting Xi, I think, to the inauguration, I think puts it more in the deal camp, that he wants to talk and he wants to cut a deal with them.
So the other bit, markets are really trying to figure out passive versus active. And then you overlay like all the credit and the private markets that are flying through the roof. This is another chart that you picked, and it's basically, showing that's tougher for passive to beat some of the active bonds. Let's bring up the charts, and you tell me what it means going forward.
So what it tells you is, in the table, is that 90% of equity managers cannot beat an index over, say, 3 or 5 years. That is what we all know, and that is not controversial. But in fixed income land, it's a much different metric. It's more like 50-50. So active managers in fixed income, just going into the game, have about a 50% chance of beating an index. And the argument that has been made now that bond yields are 5%, and as I said, maybe stocks are going to return you 6 or 7 with a little more volatility, that bonds are in the game. The best strategy is a passive approach with equities and an active approach with fixed income.
Yeah, where'd you buy in fixed income?
Well, that's the that's the professional.
To get that right.
The professional manager would do it in there. But I mean, where do you buy in fixed income? I like mortgages. I'm not so keen on corporate bonds. I'm a little bit defensive on interest rates because I think that they could go higher. But remember, even if you're defensive on interest rates and you think that they can go higher in yield, lower in price, there's such a big yield right now that you'll still get a positive return out of the bond market.
All right, so Jim, thank you so much. Jim Bianco there stays with us. We discuss tariffs in China after hearing more from our exclusive interview with the U.S. Treasury Secretary Janet Yellen. That's coming up shortly. Also, a good conversation on crypto. I'm looking forward to hearing Jim's thoughts on what the Trump administration can mean for crypto, for Bitcoin, but also blockchain. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. U.S. President-elect Donald Trump reportedly invites Chinese President Xi Jinping to his inauguration, despite fresh tariff threats against Beijing. Traders cement bets of a Fed cut next week after inflation rises in line with expectations. Plus, the ECB is set to cut rates for the fourth time this year, loosening constraints on the region's struggling economy, while the Swiss National Bank surprises with a half-point cut. Now, U.S. Treasury Secretary Janet Yellen has urged the next U.S. administration to maintain the dialogue channels that she reestablished with China. Well, she spoke exclusively to Bloomberg's David Gura on the eve of what's likely to be the latest round of economic and financial talks between senior officials from the two nations.
We've put in place tariffs. Now, they're strategic. They affected $18 billion worth of trade, certainly not all of our trade with China. And we did it to make sure that China's actions don't undermine our own plans to support these sectors. But broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness of firms that rely on those imports. So we've taken a strategic approach, focusing narrowly, and a broad-based approach I have serious concerns with, as most economists do.
Well, that was U.S. Treasury Secretary Janet Yellen speaking to us exclusively. Now, still with us, Jim Bianco, president of Bianco Research. Jim, thank you so much for sticking around. We're talking about inflation, Fed, some of the expectations that you see out there. So it's clear that, it's clear, you believe equities are priced to perfection. What do you do with gold?
Gold is an interesting one because it's having a great year, and a fun statistic for you. This is the first time ever that the S&P 500 and gold will be up 25% in the same year. Now, why is that? Because I think the market is signaling to us it's worried about too much monetary stimulus. No. That's got the gold guys going. It's got the stock guys excited that too much monetary stimulus means liquidity. So in this environment that the Fed is cutting rates and still talking about monetary stimulus, I think that the bid for gold will continue and it'll keep going.
But is it also a breakaway from dollars? So longer term, do you see a lot more central banks trying to challenge, I guess, the supremacy of the U.S. by buying not treasuries, not dollar?
Yeah, there's, especially the BRICS, they're going to continue to try and break away from the dollar. The problem is they're going to have a problem doing it because the rule of law, the deep capital markets, the derivative markets, the $5 trillion a day of dollars that trade, you can't replicate that with gold. You can't replicate that with anything else. You can't replicate that with a cryptocurrency. So, it's our currency, your problem. The problem, it's been the old line about it. That's true, except, the U.S. has got to not be reckless about having that privilege that they have.
Crypto has been flying.
Yes.
Right? Since Trump got it or was elected. What happens to crypto?
Well, it's been flying because we finally got regulatory clarity. It has been a frustrating mess in the crypto space, under the Biden administration, trying to understand where things are going to go.
Right.
Hopefully, the bull case for crypto, that it has moved higher, is now that we've got regulatory clarity, the innovation will be unleashed in that Bitcoin, Ethereum, they will become more than just stores of value, more than medium of exchange, that a whole new financial system could be built, on alternative financial system can be built on these crypto rails. And now that they can start finally doing it, because it's just 2 years ago that they were jailing developers because they were building products that the regulators didn't like. So hopefully they can let that innovation go now.
Jim, Bitcoin, 100,000. What's the limit for Bitcoin at this point?
At this point, I don't think it's got much more on upside until you start to see other ideas come to play. That there's crypto rails that you could wind up seeing, that we could see it as a medium of exchange. We could see it as some kind of a use case to coming in. Now, maybe those use cases will come. It could continue to go higher from here. But for right now, it's really stalled out for the last month or so around this $100,000 level.
Regulators had concerns about it being, used for money laundering and dirty money. Do those concerns just disappear with the new administration?
No, I think those concerns are still there, but, and let's accept that they're correct. It is used for dirty money and money laundering, but it's a small percentage of the world. It's still the traditional financial system is the majority of the way that dirty money is moved. There are ways within the crypto system that they could find compromises if regulators want to work with the developers, and hopefully they will, and then they will find a happy medium.
Jim, between all of this fiscal spending possibly in the U.S., the deficit is huge. How much more can the U.S. take of it?
Well, the deficit's 6.5% of GDP, and that has been typical of what you would see in a recession, but we're in the fifth year of a recovery. Since I'm here in London, I'll say, we're waiting for the Liz Truss moment. We're waiting for the moment that the bond market says enough and that they put their foot down, and then it gets really hard to sell bonds. It doesn't look like it's on the horizon immediately, but if we continue with these deficits at this level, there will be some point like that in the future.
It wasn't even talked about during the election campaign, which is for me, it was very surprising as an outsider.
It was for me, too. And in fact, even the few times it was ever brought up, people said, nobody cares. Well, you got a better question, is where they were with it right now. And part of the reason it wasn't talked about, because it seems like both candidates were into deficit spending. If Harris had won, it would have been spending. Trump won, it's tax cuts. So the deficit is going to stay. The hope is that the Doge Committee, headed by Elon and Vivek Ramaswamy, are going to produce these efficiencies that will help to bring down the deficit. In theory, it's possible, but in reality, call me skeptical.
When you say like a Liz Truss moment, is this a big bond auction that just goes wrong because people don't want to buy it, or what does it look like?
I don't know if it's going to be that acute, that immediate event. But what it would be is interest rates keep going higher, and it becomes more and more expensive for the government to fund. Ultimately, what happened in the Liz Truss moment is when UK gilts went up enough, they broke part of the financial system, and liability-driven investing, LDI, broke. So if interest rates go up enough, the old adage is they go up and something breaks, then you say, why did it break? It's because rates are up. Well, what will get rates down? You've got to bring the deficit under control. That is more of an evolving kind of thing, as opposed to it's acute on one day that we can't get an auction done. But that still could be very disruptive, too.
Jim, when you look around the world, where else do you invest? If you're the UK, this depends quite a lot on the personal relationship that the Prime Minister of a country at a specific time has with Donald Trump. So is it impossible to park your money, as it were?
Well, the dilemma that global investors face is the story is well known in the U.S., and the story seems to be very positive in the U.S., and you're going to pay huge multiples and premiums to buy the U.S. The story's a little murkier in Europe. Germany and France don't even really have governments at this point. But you're also getting a much better deal. You're getting those at much lower valuations. And so I think that, for the value investors of the world, they should probably be shifting away from the U.S. Europe looks like a very good value play right now. Sure, it might struggle a little bit in the future, but the growth momentum players will probably continue to stick with the U.S. But I kind of like the idea of the value play in places like Europe.
Okay, Jim, so good to have you on. Thank you so much for doing this. Jim Bianco, they're president of Bianco Research. Now, Adobe has given a